How we doing, everyone? Today is Tuesday, July the 30th, 2024, and we're just doing our Zoom session here on seller financing and real estate notes. So I'm just gonna cover today. We're gonna go through the pros and cons of seller financing. We're gonna discuss a few things that that we feel are the pros to it, and some things that you have to consider as a con. But even with some of the cons, there's ways to protect yourself, have a third party or other people involved that will assist you in some of those other some of those cons that we have out there. So, anytime that you do anything within real estate, nothing is 100 proof. There's always something that can happen, and we just want to, make people aware of all the things that are positive about it, and some of the things that may not be so positive. So that being said, so the first advantage is shorter marketing times. Many times when you advertise owner will finance, you see an increased amount of buyers. You probably will still get the same people who are qualified for a mortgage or who've been approved by a bank to purchase a home to come look at your particular property, but you are going to get probably another 30% of people who were denied. Depending on what statistic you look at, somewhere between 30 to 40% people who try to get approved for a mortgage don't. They get denied. But that doesn't mean that out of that 30 or 40%, there may not be a handful of people in there that could possibly purchase your house or be a homeowner. A lot of times they do have the financial resources to become a homeowner. They just don't check every box that a bank is looking for. But when you're doing owner financing, you don't have to be as restrictive with buyers as a bank would be. Uh, they're seeing, and if you look at industry statistics, it'll tell you that it probably sells at about 20% faster because, again, of the more buyers that are coming to look at your particular property. Uh, Another advantage is a speedy closing. A lot of times with seller financing, you don't have to go through long inspection periods, long attorney review periods, getting all the documents from the bank in order. A lot of times can take 30 to 45 days and sometimes longer when you're going through a bank and through a traditional lender. Closing a transaction can take, anywhere from 30, 45 days. And like I said, even longer. But when you do a seller financing, a lot of times you can get things done in I would say in about 10 to about 20, 25 days, something like that, so right around 10 days to about 3 weeks or so, for it to be able to close. So if you are someone looking, it's speed and efficiency is something that is a key driver of why you're trying to sell. Seller financing is going to be the way that you want to go. Well, you at least want to consider it, due to the fact that you can close this a lot quicker than you would a traditional for a traditional buyer. You can maximize the selling price. Seller financing is considered an amenity and can get you anywhere between 10 to 20% above the asking price, just depending on what market you're in and what's going on at that particular time. But you can sell your property at a premium because you are offering this type of situation. It's like if you get, a swimming pool, or if you have a sauna in your house, it's considered an amenity when you offer seller financing. And when a appraiser actually goes out and appraises the house, they put this, under amenity when seller financing is offered. So it's in the industry, it is considered to be an amenity when you are offering seller financing. The alternative to lowering your price. So if you've had a property on the market, let's say 30, 40, 45, 60 days. Maybe you're not getting the activity that that you'd like, or the offers that you received during that particular time are lower than your asking price. Uh, Selling with seller financing is a way where you can prevent yourself from having to lower the price or come down on the price when you offer seller financing. So that's another positive thing about it. You have reduced restrictions in terms of what type of credit you would accept from the actual buyer, what type of down payment that you would accept, and the sources of income. These are things that are really big right now. A lot of times people who are getting approved for loans, a lot of times have A plus type of credit because of the market that we're in. And if they don't, they're going to have to pay more for that particular loan if someone is, under a 680 or, under or around a 620 or lower. There's a lot more that goes into getting that loan approved, and there's going to be some additional costs and things like that. So you're not going to necessarily do that when you're looking at someone that wants to purchase your home with the seller financing. You can be a little bit more lenient with credit. Obviously we want to make sure that, there's certain things that are not on there, nothing that would really scare us, but maybe the person just had life happen to them during COVID or something like that. And, their score is a little bit lower, but, they're working, making good money. You can be a little bit more flexible on that. Down payment. If you look at the industry statistics when it comes to seller financing, the average is over 20% in terms of a down payment. Now you can accept that, or you could accept, something a little bit less. Obviously, the more you can get down, the better it is for you as a person offering seller financing. But a industry kind of average is over 20% for a down payment. So again, another advantage. A lot of times people understand that they may have something on their credit or been through something, and so they're able to bring a little bit more cash for the down payment in order to be able to do this deal. And then also source of income. And this is probably going to be something that's going to be big, going into the future now. We have a lot of gig workers. We have a lot of people on social media, different platforms. You have gamers. You have a lot of people that make money in a lot of different ways. And some of them are not in the traditional ways. And a lot of times when banks look at that, they may say, we don't know if we want to extend a loan to this particular person because, they make a decent portion of their income doing some type of gig work or something outside of the traditional 9-to-5 job. And because they're doing that a lot of times too, is because banks are pulling back on credit right now. They're not extending as much credit because of all the things going on. And that's, again, playing into the reason why we're putting out this information is because there are a lot of market forces and things that are going on as well that make offering seller financing a benefit for both the buyer and the seller. You have fewer costs. When we're creating seller financing for a buyer, we don't do things like origination fees, or we can keep them low. We don't charge points. PMI is private mortgage insurance. Usually, if you're not putting down at least 20% when you're buying a property, your loan comes with PMI, and that's an additional fee. And I've seen fees be $175, close to $200 on a lot of loans. That can make a significant difference when someone is qualifying. Maybe because they're not putting down 20%, they're only putting down 5 or 10%, and they have to get this PMI, and then that payment, makes it a little bit too much for them to handle. And so therefore they can't get qualified. No junk fees. A lot of times when they're creating these loans, these banks and things like that, there are a lot of junk fees, a lot of little costs that add up. And we don't do that when we're offering seller financing on a property. Majority of the funds goes towards the person building equity. So that, 20% or more that they're putting down, a large part of that goes to the actual equity in the property. Obviously, there are, some costs that are going to be associated with a person purchasing a house and, getting having to go through the process of making sure that they're qualified, but it's not going to be anywhere near what you would have to pay in a traditional sense. Another advantage is interest income. 2 to 3 times the amount of the loan, depending on the rate and the term that you do when you create your seller financing. So, let's just say you have $100,000 worth of equity, but you don't necessarily need $100,000. You are going to maybe take 25,000 of that and do something with it right away. And then you had this 75,000. You could actually gain interest on that amount of money, that's 75,000 over time. And the longer you hold it, the more interest builds up and the more that $75,000 grows, as opposed to just putting it in a bank, putting it in a mutual fund or something that is low interest, that has low interest. You could charge a certain interest rate to, for the balance of that money to be paid back to you over time. So again, that's another advantage for the seller. Now you're not just getting 100,000, maybe you're going to get 125,000, 130,000, when the time is that, that balance may be due, and that's going to be up to you as well. The installment sale, tax deferral. Now, I'm not giving any tax advice, legal advice, or anything like that, but, if you have a property and you have equity, you want to sit down with your tax person, whoever handles, your financial business, and talk to them about doing an installment sale. And what I'm going to do, I'll probably do this on Thursday. I'm going to go through an article that talks about the installment sale and tax deferral. And we're going to go through it a little bit, and it's going to break down, how this works and why it's a benefit for you. So we'll do that, on Thursday. So if you can catch me on Thursday, look for that. We'll kind of go through what the installment sale tax deferral is, where you're not having to pay tax on that whole $100,000 of equity that we talked about. You can maybe just pay taxes on the $25,000 that you realize up front, and then the balance of it kind of gets spread out over time. And there are ways to, reduce that particular tax burden for the balance as well. And that's something that you should definitely discuss with a, tax professional and see how it applies to your situation. But we will go a little bit more in depth in that on the article, and kind of, it shows you numbers and things like that. So we'll do that on Thursday. You have a secure asset. You have the real estate as collateral. So it's not like a stock or something like that, a bond where, if something happens, it loses value. There's nothing that you can do with it. You just have to wait until it kind of goes back up. The real estate, is your collateral. You can always get that real estate back if something happens, if that particular person, because life happens to everybody. And like we said, we can't, you can't predict everything. You try to guard against, certain things that could potentially happen, but, you never know. Nobody expected for us to have COVID, about 4 years ago, and that happened. So life, takes turns and does different things. And, sometimes things happen to people that you put in the property, no matter how careful you were as to who are in there. But the best thing is that you can get that particular property back and then be able to do something with that property once you get it back. And then also too, when someone, puts down, close to 20%, 15%, upwards of 25% down on a property, a lot of times they're going to be in a position that they're really going to want to work with you so they can protect their equity. So these are all advantages of, doing seller financing and offering seller financing on a particular property. And it's also a liquid asset. If at any point, how we talked about earlier, if there's $100,000 worth of equity and you only take $25,000 initially, and you're going to have the balance of the 75,000 paid to you over time, in 2 years or 5 years, if something happens and you need X amount of dollars to come to you, you can liquidate those remaining payments for cash now. So it's not like, you won't be able to get to this particular money. There is something that you can do. You can sell your note to do that, or you can do something called hypothecation, where you can pledge the note that you created with this seller financing for cash from a bank or a lending institution. You would put the real estate note or the seller financing that you created up as the collateral, and then someone will allow you to borrow money against it, depending on what the new rate is on that money that you're borrowing, or for how long and everything like that, how many payments they're gonna, hold that collateral for. All that stuff is going to get worked out. Depends on what you need. If you need another $25,000, say, then we can kind of talk about, the terms based on you getting $25,000 now. So you are liquid with this particular an investment. And then even in that scenario, if you sold some of the payments, let's say there's 100 payments left on that $75,000 that you're owed. If you sell, let's say 50 of them, the next 50 that's still owed, because it was 100 payments, would revert back to you. So not only were you able to cash in right now and get some more money from it, you're still owed a certain balance in the future. After that 50th payment that you sold off, it's going to come back to you. So these are all advantages of creating a note and seller financing, on a particular property. And so those are the pros. So some of the cons. Time is money. Waiting to get paid is the biggest drawback. You're going to have to try to get paid over, or what you're looking to do is get that balance in the example that would use of $75,000, and you're going to get that over time, whether it be 10 years, 15 years, 20 years, whatever the case may be. It's going to take a certain amount of time. But is that really a big drawback? Because you didn't need it for anything right now. So, like I said, some of these disadvantages are not really that big of a deal, because you've already said, I can wait to get the balance of that 75,000. And we've already said that if you do have some type of event that happens in your life and you need to sell it, you need to cash in on those remaining payments, you can do that as well. You do have to, stay up and track the payments. I mean, you don't have to necessarily do this. What you will want to do is hire a servicing company, and servicing companies are pretty inexpensive. And a lot of times, if you're seller financing or your note is created properly, the person in the buyer of the property can cover that cost for you. It's usually between like $30 to $50 a month. And they will make sure that the payments come in. They are keeping track of how the amortization schedule on that remaining balance is being updated each and every month, every time a payment is made. You have something called the 1098 mortgage interest statements. Again, a servicer could handle this for you, but if you didn't want to do it for whatever reason, these are some of the documents and paperwork that you're going to have to kind of stay up on and keep track of, and make sure that your records are all in order, if and when, the future, something happens or something comes up and you need to resolve an issue. You have to make sure that all of this stuff is, taken into consideration and you have the proper information. Late payments, like we said earlier, life happens to people. So someone could be late on a payment. They're supposed to pay on the 1st. Maybe they can't pay until the 15th or at the end of the month, this particular month. So sometimes you'll see that there are people who may not make a payment this month and may make 2 payments next month. They may skip this month, make next month's payment, and then 2 or 3 months from now, make a double payment or something like that. So you may get some late payments and things of that nature. And that's something that you're going to have to, possibly could happen because of the person that's living in the property, something may have happened to them. So that is a possibility. Delinquent taxes. A lot of times, what we want to do on this is make sure that the taxes and insurance are escrowed. Sometimes they leave it up to the homeowner who's living in there in the property now to make sure that they pay their own taxes. But I think it's better if we make sure that, we escrow them and make sure that they are being paid. But what's happening now, a lot of people coming out of, COVID and everything like that, they're finding that their tax bills have gone up considerably. So that could change things for potential buyers. And as a note holder, if you did not put enough money aside to make sure that the taxes were paid. That's not something that happens a lot, but because, recently we're starting to see a little bit more of that, people getting these large tax bills and things like that. These are things that you want to be cognizant of and possibly could happen to you. Lapsed insurance. Again, the homeowner is supposed to keep insurance on the property. So, and you would be a named payee on the policy. So if they didn't make their insurance payment, obviously you would be notified, and you want to make sure that, that the house does have insurance on it, even if you have to put some on yourself. And we know, and especially times like now, things are getting a little bit tight. Some people, are trying to make it week by week and month by month. It is a possibility that the insurance could lapse. But again, what we do to protect ourselves is that we get this stuff escrowed, and we have our servicer, helping us maintain and looking and seeing what, future tax payments could be and things of that nature. And they'll help us stay ahead of the game a lot of times when it comes to these particular issues. You don't get any bailouts. A lot of times when, we're stepping in as the bank, I'm sure everybody remembers 2009, 2010. A lot of banks got bailed out during the great financial crisis. Obviously, that is not something that they're going to do for, someone that has maybe one or two properties that they sell or finance. We're not going to get a bailout. So we have to, make sure that we're doing things a certain way to protect ourselves in case we have some of the situations that have happened in the past. And there's ways to protect yourself against that. And we kind of talked about them because, somebody's putting down a significant amount of down payment. A lot of times we can get the house back as collateral, and then we can exercise other exit strategies if we don't want to, do seller financing again on the property. There's other things that we can do once we get the property back. There's other exit strategies, and we'll cover those at a later date. Foreclosure costs. You do want to try to set some money aside in case you do have to foreclose. That's something that could potentially happen. A lot of times when it comes to seller financing, you don't necessarily have to do that for some of the reasons that I named earlier. A person is not going to want to give you 15, 20% down on a house and then live in a house, build up equity just for you to foreclose on it. There are certain things that they'll probably be willing to do to make sure that their interest in this particular property is, is taken care of. But you have to, you may have to file that paperwork, and that, will cost you some money to do that. It differs in every state. So you have to just be cognizant of that. Property condition. Sometimes, we think we're getting somebody in the property, and they don't necessarily keep it up the way that we would like. So again, that could be a negative. So, there's no way that you would know that. You could possibly see how this person lived at their previous residence. If they were a renter at one time, you could talk to the landlord that they rented from. How did they keep the property? But again, it is something that could potentially be a con, if you get the property back with some amount of damage. But again, there's things that we can do to make sure that, it's not the worst thing that can happen to us, and it doesn't really kill, the deal, so to speak. Now you may, in certain instances, when we do this, there may be a first lien already on the property. So you can still sell or finance a house even though there's an underlying lien. Maybe you bought the house from you got traditional financing from a bank and you lived in a house for 10 years and there's still a balance, but you want to offer seller financing to someone. We have to make sure that that first lien continues to get paid. That's going to be your responsibility to do that, to make sure that it gets paid. So, that's something that you have to be cognizant of, and you don't want to not miss, that payment, because then, it could have bad effects on your credit. There is, and if you do this with an underlying lien, one of the cons is called a due on sale clause. So technically there's verbiage in a note in a mortgage that's written up when you go to a bank that says, if title to this house transfers from you to someone else, they have a right to call their lien due. Now, it's something that doesn't happen a lot. I would say out of 100 times, it may happen twice, 3 times, maybe. So about 95% or more of the times, this does not happen. But again, it is something that we have to be cognizant of. And if that is the case, we have to make sure that we're in a position to make sure that that underlying lien gets paid off. And it's not like they're just going to take the house within 30 days or something like that. It is going to take them some time to foreclose on, and execute this due on sale clause. So we have some time to make sure that, we could get that rectified. And the way that we try to help people in this instance is that when we create the seller financing for someone else, we create it in a way that we can sell the note that we created to make sure that our underlying debt gets paid off if and when it needs to get paid off, if we're forced to do it. A lot of times people don't write them that way, and it becomes a bit of a situation when I can't, get enough money. I can't borrow enough money to make sure that this underlying lien is paid off. But that's how we are different. We structure these things where, if this does come up, we know that we can take the seller financing wrap that we created for a buyer, because we wrapped it around that underlying first lien that was there. So that's what a wrap is that, it wraps around that first lien. We can take what we created for our buyer and sell it. We can sell that note for amount of money that will cover that underlying lien. And there's also something called a discount. When you create seller financing, 95% of the time, you're not going to be able to sell the note for what they call the face value. If there's $100,000 left on your note, you're most likely not going to be able to sell it for that whole $100,000. Sometimes you are able to do that, but typically in the business, that's not what happens. You have to sell it as somewhat of a discount. And so, what you want to know is, what potentially am I going, if I had to sell this, what would I have to sell it for? Now, we try to make sure that it's written correctly on the front end, so you don't take a significant discount when selling the note, if and when that you have to do that. But that's all done, ahead of time, where you create it properly, you create it at a good interest rate, so you don't have to sell it at a steep discount. And then also those pesky laws, the CFPB, Dodd-Frank, the SAFE Act, there were a lot of things put in place after the great financial crisis that you want to be mindful of. But again, the reason why this is a con somewhat, because, we have to make sure that we are compliant with this stuff, but, we can get a third party, a lot of times an attorney or a registered mortgage loan officer, which is an RMLO. They can help us, preparing this information, making sure that we are staying compliant. A title company can make you do that as well. But you have to make sure that, that you're doing everything that's required of you in your state and not having a problem with any of these laws that are in effect. But again, we have people that can help us with that, and when we're creating this, to make sure that it's created the best way. So that's it for today. Just wanted to go through some of those pros and cons with you. Hopefully that made sense. If there was anything that didn't make sense, I need a little bit more clarification. Please leave a comment when you watch the video, or you can reach out to me. My email address is investorgmr@yahoo.com, or you can call me or text me at 973-475-8488. Let me know your question. If you'd like me to explain something a little bit better, I'll make sure that I do that. But on Thursday when we come back, we will go through an article, and we'll break down this installment sale. So to give you a little bit better understanding from a tax perspective. Now, I'm not giving you tax advice, but just want to kind of show you from a 30,000 view on how the installment sale works for your benefit. So we'll go through that on Thursday. All right. So hopefully you got the good information, and we'll see you back on Thursday, hopefully. All right. Have a good one.